What credit score do you need to qualify for a mortgage? How much home can you buy given your income? And just how big of a down payment should you make? We'll answer these questions and more on this, the 36th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Everybody, it's day 29 in our 31-day money challenge, my effort to kick off 2014 with 31 podcasts in 31 days, all geared towards helping you make the most of your money and to move forward towards financial freedom. Today, we're going to talk about mortgages. I've had a number of folks during this 31-day money challenge email me and had questions about credit scores and mortgages, how you get a mortgage if you're self-employed, if you're a business owner, a number of other questions. And so what I thought I'd do today is kind of go down about 6 or 7 sort of the big questions that folks have. Everything from how do you qualify for a mortgage? Should you get a 15 or 30-year mortgage? Should you get a fixed versus adjustable mortgage? Those debt-to-income ratios, which you may have heard about. And so we're going to kind of cover all of that today. So that's our plan. Tomorrow, just to kind of finish out the month, tomorrow we're going to be talking about the various types of retirement accounts. 401ks, IRAs, 403bs, Roths, traditionals, deductibles, IRAs that are deductible, IRAs that aren't deductible. Where should you invest first? Is it always good to start with your 401k? Should you open an IRA instead? Can you have an IRA if you have a 401k at work? And we're going to kind of jump into all of that tomorrow. And then on Friday, the last day of this 31-day money challenge, I'm going to kind of wrap it up. I've got a ton of reader questions and comments that I'm going to address that day. They've kind of piled up over the last week. I've been responding to folks via email, but I haven't shared them all in the podcast. And so I thought I'd cover a lot of those on Friday as well. So that's what we've got planned. As I said, today it's all about mortgages. So let's get to it. Let me first thank our sponsors. Betterment, an online platform that invests your money in both stock and bond ETFs. You just pick the percentage you want in each. Betterment does the rest. They rebalance for you automatically. They also reinvest your dividends automatically. You can check them out at betterment.com. And Personal Capital is a free online tool that allows you to bring all of your investments together in one place. Retirement and non-retirement, they will track your performance for you. They will track your asset allocation across all your investments, as well as the fees that you're paying. You can check them out and give them a try at personalcapital.com. Okay, so before we jump into mortgages, I just got to make a comment about the market. So I'm recording this. It's about 10:15 in the morning on the 29th of January, the day I'm going to publish this podcast, and I'm looking at the markets, and they're down. The S&P 500 is down about 11 points, about 0.6%. The Dow's down over 100 points, and anyone that follows the markets know that they've been down this year. And it really gives us a good opportunity and gives you a good opportunity as you think about how they've performed this year to think about how you react to risk. I mean, the reality is that the market declines this year are modest as compared to what we've experienced in the past. Now, they may continue. I mean, this year could end up being an awful year. Obviously, we don't know. But I think it gives us a real good opportunity to sort of for a gut check to see if your asset allocation is what it should be, both not only in terms of your future goals and the kind of returns you're looking for, but just your own risk tolerance. I mean, for me, when the market's down like this, I get kind of excited because I start to look at buying opportunities, even if I'm not actively trading in an individual stock, which I do, but rarely. Just reinvesting my dividends or investing. I'm going to be making a SEP IRA contribution here in the next couple of days for 2013, and I think this is great. I'll buy more shares than I could have bought at the end of 2013. Same is true for 401k contributions. That's my reaction when the market goes down. Again, this is money that I'm investing that I won't need for 20 years or more. But how do you react to it? And that's a question we each have to ask and answer for ourselves. But I think this market decline as relatively modest as it is, it still hurts. And, the market's been down for 2014 so far. It gives you a chance to really reflect on your investment philosophy, and I think it's important to do so. Again, from my perspective, I'm not making any changes to my asset allocation at all. I'm not selling anything. I could pull the trigger and buy some things. And if I do, I'll talk about those in upcoming blog posts and podcasts. I haven't done that yet, but I suspect I'll be buying a few things here soon, and I'll talk about that. By the way, in just a few minutes that I've been talking about the market, it's dropped another 0.1%, and the Dow's now down 132. It's amazing. You can sit here and watch this, and I got an email from a reader, and I'm going to talk more about it on Friday. But it was basically, why is the performance of the market? Who cares? Why is this even important? Why do all the media track it and talk about it? And it's an interesting question. We're going to cover it on Friday, but I guess it's a question for you. Do you track the market every day? And if so, why? I guess I do, in part because I write about it. Not so much the market, but investing and whatnot. Of course, if you have index funds, they go up or down based on the market. So there's that. But a good question to ask: do you track the market? And if so, why? Maybe it's just a habit. Anyway, okay, so mortgages. So we're going to cover a number of things. I want to get right to it and kind of move right through it. You'll find a lot more detail in today's show notes. I've actually written the show notes a little differently today than I have in the past. Today's show notes are really a full-blown substantive article about mortgages. It's not just a list of the topics and the resources. Tons of links in the article today, both to other articles I've written in the past as well as to other websites on the topics we're going to cover. But definitely worth checking out the show notes today, which you'll find at DoughRoller.net/podcast 36. So with that, let's jump right into it. The first thing I want to cover are credit scores. Credit scores are critical when it comes to mortgages, and they're critical really for sort of three related reasons. The first is you have to have a certain credit score just to even qualify. As a general rule, you want a FICO credit score of 620 or higher. Now, can you qualify for a mortgage with a lower credit score? Yes. But there'll be strings attached, higher interest rates, perhaps higher requirements for down payments. In fact, an FHA mortgage, and again, there's links to all of this in the show notes, but an FHA mortgage, you can actually technically qualify with a credit score as low as 500, although you may have trouble finding a bank who will actually make the loan if that's your credit score. But with scores that low, you'll have to pay more for down payment. FHA loans are known for their 3.5% down payment requirement, but when your credit score goes below about 580, that down payment requirement jumps to 10%. So there are ramifications for credit scores that are that low. Really, you want to shoot for a credit score of 620 to qualify for most mortgages without a lot of grief. That's the first thing about credit scores. Now, the second thing is qualifying is one thing. You obviously want to get the lowest interest rate you can possibly get. And that's where credit scores really become important, because as your score then rises above 620 and hits certain ranges, the interest rate that you'll qualify for goes down. And the difference is very, very significant. And in the show notes, I've got this laid out based on a number of different credit score ranges, starting with 620 at the low end all the way up to a perfect score of 850. You don't need, by the way, a perfect credit score to qualify for the lowest interest rate. Typically a score of about 760 will do it. But you'll see in the show notes, I use an example of a $250,000 mortgage on a 30-year fixed term. And the difference in interest rates is significant. I mean, it's about 1.6% difference from the low credit score of 620 up to a higher credit score of all the way of 760. And on a $250,000 mortgage, principal and interest, the difference in payment is $240. Very, very significant. So the higher your credit score, not only will you qualify more easily for a loan, but you'll get a better interest rate. That's the second thing I want to mention about credit scores. So very, very important to get the credit score up as high as you can if you're buying a home or refinancing a mortgage. And then the third thing is, because credit scores affect interest rates, and because interest rates affect your monthly payment, they also affect how much you can borrow. So the higher your credit score, the more you can borrow given the same income. So in other words, say two people or two families have $100,000 a year in income. The family with a credit score of 760 will be able to borrow more than, say, a family with a credit score of 620. And the difference is quite significant. particularly as the mortgage amounts go higher. So credit scores are really, really important. Now, one other thing I want to mention before I move to the second topic related to mortgages today is this. I often get the question, well, wait a minute, we have multiple FICO credit scores, right? There's 3 credit bureaus, so assuming we have a credit file with each, we have 3 scores. And then if we're married or if it's a joint application for a mortgage, there's 2 folks involved. So how does all that work? Which credit score do they take? Well, generally, here's how it works. If you have 3 credit scores, 3 FICO scores from your files at the 3 credit bureaus, and most of us do, they take the middle score. So they get scores from all 3, and they take the middle one. If you happen to have just 2 credit scores, and that does happen from time to time, they take the lower of the 2. But if you have 3, like I think most probably do, they take the middle score. Now, what about 2 borrowers? Well, again, they'll take the middle score from each borrower, and then between the 2, you think they might average them. That's what I would have guessed, but they don't. They take the lowest score. That's important to know. If you're gearing up to buy a home or refi and you check your credit scores, and one of you has a much lower score than the other, or it doesn't even have to be significantly different. I mean, it can be 20 points difference, and it can have an impact on your interest rate. You need to improve that lower score while keeping the higher score where it is or whatnot. But that lower score is the critical one. So that's typically how they do it when you've got multiple borrowers. Again, you can confirm all this with your bank or your mortgage broker, whoever you use to get a mortgage, but that's generally how they do it. So that's credit scores, very, very important to the mortgage process. Now, the second thing is what's called a debt-to-income ratio. And this is where they, of course, take all your debt and they compare it to all of your income, and they calculate a ratio. And they actually calculate 2 ratios. One is called a front-end ratio, and one's called a back-end. So how does this work? Well, the front end is simply what your mortgage payment will be based on the mortgage you're looking to get, and that includes principal, interest, taxes, and insurance, the whole payment, and they divide that into your gross monthly income. So, for example, if you were going to get a $2,800, if your mortgage was going to cost you $2,800 a month, and your gross income was $10,000 a month, they would simply take the $2,800, divide it into $10,000, and your front end ratio would be 28%. And I use that example because that's generally the most it can be. The general rule of thumb, there are always exceptions, and these rules are constantly changing. So you're going to want to make sure this is the right for the mortgage program you're applying for. But generally, you want a front-end ratio no higher than 28%. Now, I will tell you from just a comfort level, I like to keep my mortgage payment at 20% or lower of my gross income. I found that when it goes above that, it's a significant budget item. It starts to hurt, and really, obviously, you want it as low as you can possibly get it. I find that when you get to the 15 and then down to the 10% range, the mortgage payment gets really comfortable. But in terms of qualifying, as a general rule of thumb, you need a front-end ratio of 28%. And in the show notes, I have examples of all of this, including, again, various credit ranges, how that then affects the interest rate that you'll qualify for, how that then affects your monthly payment, and then how that affects the income you would need to qualify. So these are all very interrelated. That's the real takeaway here. And you'll see that in the show notes. So the back-end ratio is similar, except that you don't just focus on the mortgage. They pull in all of your monthly payments on all of your debt. Now, we're not talking about utilities and food and clothing expenses. We're talking about car payments, minimum credit card payments, payments on your school loans, and of course the mortgage that you're applying for. They add all of those debts together and divide that by your gross monthly income to get a back-end ratio. Now, back in the day, they were looking for something around 36%, maybe 38%, no higher than that. I've seen programs today where you can get this ratio as high as about 43%, and there may be other programs. I mean, these things are, again, not set in stone. They tend to change from mortgage program to mortgage program. But I think generally you want to try to keep it at no higher than about 36% to put yourself in the best position to qualify for mortgages at the best rates. And really, again, when you start to go above that, while you might be able to qualify, it really gets tough in terms of the monthly budget. When you factor in all the other expenses you have to pay, hopefully you're saving for an emergency fund and retirement and all these other things. When you start to get your back-end ratio above that range, things start to get very, very uncomfortable. Okay, so third thing, down payment. That's always a big question. How big of a down payment do you need? So Before the housing crash back in, I guess, the end of '07, you could get no money down loans. Today, those really aren't that common. The only no money down loan that I'm familiar with is a VA loan. So if you're a veteran, you qualify for a VA loan. It's a great program. Absolutely check it out. But beyond that, the smallest down payment of sort of a widely available loan program that I'm aware of is an FHA loan for first-time home buyers. And you can get a mortgage for 3.5% down payment. Now, beyond that, if maybe you don't qualify for an FHA loan, you just want a more conventional loan, there are 5% down loans out there, and I linked to some information about them in the show notes. So I would say, if you for a VA loan, you can get a no money down loan. For everything else, if FHA, you're looking at about 3.5%. Beyond that, you're probably looking at least 5%. Now, again, that's what's available. It's still, the question is that what is right for you? I think ideally you should put 20% down. Why? Well, one, you avoid what's called PMI, or private mortgage insurance. If you have a low down payment below 20%, you typically have to effectively pay the insurance premium that the lender will take out in case you default, and it typically insures up to 20% of the amount of the mortgage. So if you can put a 20% down payment on and then just borrow the rest, the other 80%, you don't have to pay PMI, and that can be a significant amount of for the monthly budget, and it gets wrapped into your mortgage payment. So the first thing a 20% down payment does is gets rid of that PMI requirement. The other thing it does is it just gives you a cushion in case the market declines. I mean, we've read, if you follow the news, that when the market crashed in '07, '08, tons of people were underwater now, on their mortgages. Now, if you're not going to move for 10 or 20 or 30 years and you can still pay the mortgage, it's maybe not a big deal. Psychologically, it's probably not a lot of fun, but may not affect you day to day. But what if you want to move and you're underwater, and now it takes away options. Now, that being said, did my wife and I put 20% down on our first home? No, we put 5% down. It's what we could afford. So do I think that kind of decision is the end of the world? No, I don't. It worked out very well for us. But I guess the key here is to know it comes with risks, and it comes with additional costs in the form of PMI. And sure enough, we had to pay PMI. And when we made some extra payments on the mortgage, and the market went up, and our home value eventually went up, we were able to get out from underneath the PMI. But that was a not an insignificant cost. So that's what you need to consider when you start to think about a down payment. Okay, next item. So let's see here. Let's review. We've talked about credit scores, debt-to-income ratios, front end and back end, down payment requirements, and maybe what's right for you, even if it's beyond the requirements. Now we're looking at the perennial debate, 15-year versus 30-year. So I'm a big believer that there's no right answer here. I think either one can work. We have always had 30-year fixed-rate mortgages. Why? Well, because when we've borrowed, the difference in interest rates between a 15 and a 30-year was not significant. 15-year mortgages are almost always, I think maybe always, a lower interest rate, but the difference wasn't significant. And I wanted the flexibility of making a smaller payment. I'm just conservative that way. We've always fortunately been able to make our mortgage payment, but I've just wanted to keep it as low as possible. And now we currently pay more on our mortgage, so we'll pay our mortgage off in much less than 30 years. In fact, we're on track to pay it off in less than 15 years. But, if we had some trouble, if we needed to conserve some cash, we could make that lower payment. So I personally love the 30-year fixed rate mortgage, particularly now, given how low rates are. I mean, they're not quite as low as they used to be earlier in 2013, but they're still historically very, very low. So I'm a big fan of the 30-year mortgage. Now, a lot of folks, though, will argue for the 15-year mortgage because it effectively forces you to pay extra on your mortgage and to pay it off sooner. And that's true, it does. And I think a 15-year mortgage is a great choice. I'm just not one that thinks it's the absolute way to go for everybody. I like the lower payment. But again, I think either choice is fine. And you should look at the spread in interest rates because they vary from time period to time period. It's not always the same spread in interest rates between a 15 and a 30-year. But again, for me, when you factored in the deduction, tax deduction, the difference in the spread on an after-tax basis just wasn't worth the increased payment. So that's what I did. We did the 30-year fixed. I think 15-year mortgage is fine. We did the 30-year, paying it off early. We'll probably pay it off in under 15 years. But I think either choice is reasonable. Now, the next item, though, I have a very strong view of, and that's fixed versus adjustable. So if fixed rate mortgages, one, you get your mortgage rate and it stays the same over the life of the mortgage. Ours is 3 7/8 on a 30-year fixed, and it will never change. An adjustable rate mortgage, as you would think, the rates can change, and there are different kinds of adjustable rate mortgages. Some will change after the first year and every year. Some change after 5 years and only every 5 years. And with most adjustable rate mortgages that I've seen, there are caps. They can only adjust by so much each time they adjust, and they can only adjust by so much over the life of the loan. But what I have found is that most folks that get attracted to adjustable rate mortgages do so because the initial interest rate is typically lower than a comparable fixed rate mortgage. The problem is you leave yourself exposed to rising interest rates, and you leave yourself exposed to rising interest rates on a debt that for most people is by far the most significant debt. It's their most significant payment each month. And I just don't like taking that risk. I just don't think that for most people it's a risk worth taking. Certainly it's not a risk that we were willing to take. Now, I will say that on my investment properties, we've had adjustable rate mortgages. However, part of that was because we were getting, and I won't dive into all of this, and I'll talk about it in an upcoming podcast when we talk about real estate investing, but we were using a portfolio lender. We were not getting a conventional loan, and they offered a good adjustable rate mortgage for 5 years. So it would adjust only every 5 years. And the mortgage amounts were very, very low. It wasn't, our last home that we bought, I think the total mortgage, including all of the rehab costs that we did, was about $60,000. And so, I was willing to take that risk there. However, even there, we eventually refinance all of our properties to conventional fixed rate mortgages. So in my view, fixed rate is the way to go. I think adjustables, while you get that lower rate up front, it just injects too much risk into what's a significant payment for most people. I know it has been for us. I just sleep better at night knowing that my rate is not going to be going up. Okay, 6th point is, what if you're self-employed? A reader asked me this question early in the 31-Day Money Challenge, and I promised her I'd answer this question. So the good news here is that the standards for qualifying for a mortgage are the same, whether you're an employee or you're self-employed. The standards don't change. What does change is what you have to show to prove that you've got, to prove what your self-employed income is, your business income is, and that it's stable. So normally what they're looking for is 2 full years of history on your business or your self-employed income, and they're looking really for tax returns. So if you're going to leave your job, let's say in a couple of months and become self-employed, and then you want to buy a home 4 months later, that could be a problem. It's not impossible, but it will be much, much difficult. You really should have 2 years history of consistent self-employed income backed by the tax returns. And I linked to an article that goes into this in a lot more detail in the show notes. But that's something to think about if you're thinking about leaving your job to maybe start a business. Think ahead and ask, am I going to need to be refinancing a mortgage or buying a home? And then factor that into your decisions, because I've never had to do that because I've always had employed W-2 income, even if I've had extra income on the side. But I know in talking to folks, it can be a headache, and so that's definitely something to think about if you're thinking about leaving your job to start a business. And so that's really, I think, the key elements of mortgages, the things you need to know. As I said in the show notes, there's just a ton of links that sort of dives down into all of these different issues. So I encourage you to check out the show notes. But I think at a high level, those are the key issues. Now, on my website, and I'll leave a link to this, I do have a page that actually tracks current mortgage rates, and you can you'll see it. I'll even in the show notes a link to it. But you can search for mortgage rates based on your location, whether it's a refi or a purchase. the amount of the loan, and I'm kind of just looking through them now. And what I'm seeing are 30-year fixed rates in the low 4% range for the most part, which again, a little higher than they were last year, but historically very, very low. I think in terms of financing, it's a great time to buy a house, a great time to refi if you happen to have higher rates or are trying to get out from underneath an adjustable rate mortgage. So I will leave a link in the show notes to that page. Those rates adjust actually daily, automatically. It's some code, a widget that I put in on the site. I don't actually have to go in myself and change those rates. They change automatically, so you can check that page, whenever you want, and it'll show you the rates that are current for that day, because mortgage rates do change daily. Okay, so that brings this podcast to a close. As I mentioned, you can get the show notes at DoughRoller.net/podcast 36. You can reach out to me, dr@DoughRoller.net. Love to hear from you. I'm getting a ton of email. I respond to every comment or question, and I'll be answering reader questions on Friday. So if you have any questions, get them in before then, and I'll do my best to respond to them. You can subscribe to this podcast. Just go to DoughRoller.net/iTunes. That will redirect you to the page where this podcast resides. And we have a weekly newsletter. It's free. It goes out every Saturday, packed full of resources and tips to help you make the most of your money. You can subscribe for that in just a couple of seconds. Just go to DoughRoller.net/newsletter. So that's it. Hope you, again, if you have any questions on mortgages, shoot me an email. Happy to help. And remember, until next time, the best thing money can buy is financial freedom.